Good morning, ladies and gentlemen, and would like to thank you, SteelOrbis and IREPAS, for inviting us and inviting me again this year to speak in front of such an experienced and audience. You may be disappointed I will not speak about financing and products that the bank may offer, although I will touch upon this at the very end of my presentation, but more about our views on the steel market and what has happened recently and what could happen, very modestly, of course, opinion, in the near future. So, what were the developments in this industry since last year in Paris in March 2015? Remember, at that time, rebar price was about 390 US dollar per ton, scrap price 255, coking coal price a bit more than 100, iron ore close to $70 per ton. Chinese exports had just increased by 50% in 2014. And what I'll try to do now is to have a look back at what I said in March 2015, which is always a bit dangerous as an exercise. Let's do it. So, as you may guess, green means that more or less we were right, and red that actually what we were anticipating didn't really materialize. So, bankers sometimes are not always wrong, let's say, or you may say that sometimes we are just lucky. You can see that what we were anticipating more or less happened this year. So indeed, Chinese consumption, which had declined, continued to decline. I will explain, touch upon this a bit later in the presentation. We were thinking that raw materials prices will continue to decline in price and will keep depressed during a number of years, and despite the recent, for some of them, rebound, it was the case. Chinese exports should trigger anti-dumping measures. No need to explain that this really happened in 2015. We'll explain a bit. I'll explain a bit later. So the only thing that I was anticipating is that due to the massive pollution problems in China, the Chinese government may say, what's the need of exporting so much steel to pollute our air? And do we really need this? Knowing that we import iron ore and not so much coking coal, but essentially iron ore. And actually, even if they try to do, it's a very serious problem which they are tackling. But we were thinking that they may take more, let's say, aggressive measures to limit exports, which didn't really materialize. So, indeed, Chinese consumption continued to decline. After a decline of 3.3% in 2015, it accelerated the fall of Chinese consumption, apparent demand, by 4.8% in 2015. In 2014, Chinese crude steel consumption increased despite the fall in demand, just because exports increased so much at the same time. In 2015, exports increased again, but for the first time since 30 years, Chinese crude steel production declined by roughly 2%. First time in 30 years. So how can this decline of Chinese consumption be explained? Well, you can see on the chart on the left side that construction accounts for roughly half of Chinese steel consumption. And demand for this sector declined by more than 5% last year. You can see it also on the other chart on the right side. Floor space started in 2015, declined by 14% in 2015. So it means really a massive contraction of the construction sector in China, which has an immediate impact on the apparent on the steel consumption. If you look at again at the left-hand side chart, you can see actually that many sectors, not only construction, declined in 2015. The output of machinery, shipbuilding, white goods like refrigerators, etc., containers, etc., steel demand in these sectors also contracted in 2015. The decline of the steel consumption and steel production in China is not something which is unique and is confirmed by other data of the industry. For instance, cement, which is also very much used, essentially used in construction. Cement production declined also by 5% in China. Refrigerator, white good production declined. Personal cars production also declined. I already mentioned the construction of residential real estate declined sharply by 14%. And even freight, which is also a good indicator. You know that the current prime minister said when he was the head of the province, he said that, well, as a proxy for GDP, he has a combination of power consumption, freight, and real estate. So better proxy for GDP than maybe official numbers of the Chinese statistics. And you can see that all these numbers confirm that indeed there is a contraction of not the economy as a whole, but at least of the main sector, main steel consuming sectors. So exports continued to increase from 93 million tons in 2014 to 112 million tons in 2015. If we add up the increase in exports 2014 and 15, we come up with roughly 50 million tons of steel, which represents 6% of steel consumption of the rest of the world. So the rest of the world had to absorb 6% of its consumption through additional Chinese exports in 2014 and 15, which is really a massive number. Much more, of course, than the growth of demand in the rest of the world. I said initially that we were a bit not disappointed, but surprised by maybe the lack of reaction of the Chinese government in their arbitrage between, let's say, pollution and employment and activity in the steel industry. Actually, maybe it's not totally fair. They tried to do something. So you remember that there was a loophole in the export VAT rebate through boron addition. So this changed, but the Chinese producers found a way actually to circumvent this new regulation by adding a bit of chromium and to export steel as a category of alloyed steel. So it's a bit always the mouse and cat game between regulation and the Chinese steel exporters, which find a way to change a bit their products, exactly like billets and, let's say, large square bars. If we look more in detail at the numbers for various products, so plus 20% in 2015, you can see that HRC indeed increased by 15%, but many other products increased much more modestly. Cold rolled coil even declined in exports. Plates and wire rod increased by slightly more than 5%. So something is probably missing. I don't have the numbers for all the categories, and something is missing to come up with 20% growth. And indeed, billet exports from China increased tremendously. We cannot rely on the numbers because they are not categorized as billet exports from China, the official numbers. But for sure, this number surged massively in 2015. Just as an example, imports of billets into Turkey were multiplied by 10 in 2015 to nearly 1.5 million tons in 2015. So, And this didn't happen only in Turkey, but in most of the parts of the world. Of course, after 50% in 2014 and 20%, the trend continued in 2015. The rest of the world had to react, and indeed, we have seen as it was not very difficult to anticipate that there would be anti-dumping measures in the rest of the world to limit the impact of Chinese exports. But in 2015 alone, 15 new cases were launched, anti-dumping cases, naming Chinese origins, Chinese steel origin. Now, if we look at a bit more into detail at what happened to long products and the other flat products as well. What is clear is that times as iron ore and coking coal prices collapsed, you may remember that at some stage iron ore price was $170 per ton, $160 per ton, and it fell to $40 per ton, so divided by 4. Coking coal price was above $300 per ton in 2011, and it fell to, let's say, $65, $70 per ton, so also divided by 4. It's really a dramatic collapse of raw materials, iron ore and coking coal. Scrap prices at the same time didn't, the price in scrap didn't decline in the same, with the same magnitude. There are reasons that you know better than I do, is that you can improve a lot productivity at mines when you have very big mines in Australia with large trucks, 50 million ton mines, and 90 million ton times like in Brazil, for instance. You can really produce iron ore with a extremely high productivity and come up with a cost of iron ore for Australia, for instance, or for Brazil of $20, $25 per ton. So even with a price of $40 per ton, they still can make a profit, especially if the freight rates are as low as they are now. But for scrap, it's a different, of course, another problem, because you have to collect scrap in relatively rich countries, the US, Europe, where salaries are high, where you cannot really improve productivity in scrap collection, etc. It's something very, very decentralized. So there is a kind of floor to scrap prices, and even if iron ore and coking coal raw materials prices collapse, scrap prices cannot decline with the same magnitude. So what happened is that if you look at the left-hand side chart and the proxy, which is the scrap price minus the cost of iron ore and coking coal, with their consumption in crude steel, roughly 1.6 ton of iron ore and 0.7 ton of coking coal per ton of crude steel, you can see that between, let's say, early 2013 and late 2014, the difference between scrap price and raw materials price increased by nearly $100 per ton. It means that for crude steel production, at least, electric arc furnace producers based on scrap lost nearly $100 per ton of competitiveness compared with blast furnaces, which had, of course, $100 per ton in the steel industry is something which is really massive. So at the end of 2014, I'm just speaking about the cost of producing crude steel. Of course, then from EAF you produce more long products, and this explains, by the way, why we have this kind of situation, which historically is a bit strange, that billets were $30, $40 more expensive than slabs, and rebars were also $30, $40 more expensive than HRC, which is something that historically is a bit strange and is explained by the fact that indeed scrap prices, which is used essentially or primarily to produce long products, the price couldn't decline as much as iron ore and coking coal. So what we have seen since late 2014 is that this benchmark, this differential between the scrap price and the raw material prices was reduced again, let's say to roughly the level of early 2013. So that's really when the scrap price late 2015 and early 2016 declined to $170 per ton. But now it's very recent, so it's difficult to build a trend on this. But the scrap price again has jumped to, let's say, 250, while the raw material price, iron ore, indeed has a bit declined. So again, you have this trend. You can see at the very end of the blue line, the bold line, you can see that at the very end, let's say March 2016, again, scrap is losing and EAF producers are losing competitiveness compared with the blast furnace producers. So one of the consequences of this, I was mentioning exports of billets to Turkey from China, and not only from China, and it's not only, it doesn't go only for billets, it goes also for slabs, is that many, at least those who were flexible like the Turkish companies are, preferred to buy semis instead of scrap, because just they could buy cheaper billets on slabs than to produce themselves from scrap. This loss of competitiveness to a lesser extent applied also to DRI-based producers, just because blast furnaces are using coking coal, which the price declined, while DRI producers use gas, and in most the gas prices didn't decrease. Actually, in DRI producing countries like the Gulf countries or Egypt, gas prices, well, Egypt is a bit particular, but at least in the Gulf countries, gas prices were very low and have rather a tendency to increase, as well as electricity. So the DRI-based producers lost indeed competitiveness in 2015, just because coking coal prices declined, and this can be estimated roughly to $25 per ton. So it's not only the scrap-based producers, but also the DRI-based producers who lost a bit competitiveness compared with the blast furnaces producers. So as mentioned earlier, the industry emerged from hell very recently with a spectacular rebound of prices. Just in one day, iron ore prices increased by 20% in China, in the world. Seaborne iron ore prices and steel prices followed. So something not really anticipated, and essentially driven by China, which accounts for 50% of the world output. So frankly, a lot of analysts are a bit skeptical about this rebound and whether it's really sustainable. Of course, there are a few arguments to explain this rebound in March 2016. First, it is the announcement of the Chinese government itself, which committed to, and this time it seems to be much more serious than capacity closures have been discussed for nearly 10 years in China. But this year, this time there is a sentiment that they really want to tackle this issue and to do something. So the number of 150 million tons of capacity closures has been mentioned, of which roughly 50% of this in the Hebei province around Beijing, which is one of the largest area. There is also the new plan, which made more people confident about the continuation of the investment in China and the sustainability of GDP growth at, let's say, above 6%. But even more importantly, I think, is the fact that in 2015, Chinese producers massively lost money. So they have. I've been visiting many times steel clients of the bank in China, and the metrics that we use typically in let's say in Europe or in Turkey or in the rest of the world do not apply in China. In China, you do not really look at the net debt on EBITDA leverage, because otherwise you would run away immediately. So when we say that we would prefer a company to have a leverage ratio, so net debt over EBITDA of, let's say, below 3, 3.5 can be acceptable for if the company has massively invested and you can explain the debt. In China, we are above 20, 30, and there is no limit. So that's one of the issues. The second issue is that this debt very often is short-term debt. So they finance long-term investments with money which is rather short-term. So as long as the relationship between the bank, which are often state-owned banks, and the steel producers is fine, okay, you may roll over your short-term debt which has financed long-term investments. But there is, from our perspective, and we are not the only one in this case, there is a risk, of course, of maturity mismatch. So in 2015, Chinese steel producers massively lost money. And clearly this is not sustainable, because even if they do not have to reimburse the principal, and they still have to pay for the interest. And even this is with the kind of EBITDA margin which they had in 2015 is very difficult. So there was really a need to restore margins in China. And this is, I think, one of the main reasons why prices had to rebound. The mechanism exactly why they rebound is not so clear, but there was really a need to restore profitability of Chinese producers. What is nice also for steel producers is that steel prices have rebounded much more, at least for blast furnace producers, have rebounded much more than raw materials. So iron ore was about 40%. In a few days, or let's say weeks, it rebounded to over 60%, dollars per ton. So from $40 per ton to $60 per ton, so plus 50%, which from our point of view and many analysts in the industry was not sustainable, because the fundamentals of the iron ore industry are not that good, not that brilliant. You have a lot of new mines coming on stream in 2016, very low cost mines. So as I just said before, that many Australian mines or Brazilian mines have a FOB cost of $20, $25. So with the freight from Australia to China of let's say $5 per ton, at $20 or $25 per ton, they still make a decent profit of even when the price is 40 for iron ore, CIF China, they still make a decent profit of $10, $15 per ton. So and there was a lot of capacity coming on stream. Roy Hill project in Australia coming on stream with 55 million tons, which is 5% of the seaborne market. You have Vale, which has a huge project, 90 million tons of iron ore also coming on stream in 2016. So a lot of capacity coming on stream, very low cost. So the fundamentals for prices are not that brilliant. So $60 from our point of view was not justified. And indeed, since then, prices have declined again. Now they are close to 50, and they may go back again, go down to 40 in the future. So all this to say that steel prices have rebounded. Iron ore, raw materials prices, not so much. So again, margins, at least for blast furnace producers, have been restored in over the past, let's say, few weeks, or since March 2016. As I said earlier, for scrap-based producers, it was nice during some time, but with the increase of scrap very recently, there is still some restoration of margins, but not to the same extent than blast furnace producers. So this is really what happened since March 2015. What could we expect for the next future, the next let's say few months or at least 2016? Basically, we think that the industry has reached in late 2015 and early 2016, and this is a sentiment which is shared by really many analysts in banks and or brokers in this industry, is that the industry has reached a bottom in late 2015, early 2016. So things could not be worse than they were, let's say, 2 or 3 months ago. Still, it's very, very difficult to predict, to forecast what is going to happen, because the environment, as we have seen with the price, iron ore prices, scrap prices, steel prices, is indeed extremely volatile. So if we look at one of the main drivers of the industry, which is China, and in particular, it's steel consumption, we continue to believe that Chinese consumption will decline. And actually, that's basically what the Chinese themselves are saying. When you look at the statements of the CISA, the Chinese Steel Association, they forecast that by 2020, Chinese steel demand may reach 600 million, so a decline from the current level. Why? Well, the first reason is that, as I was explaining last year, and it's still the case, the share of investments in Chinese GDP, in Chinese growth, is still extremely high, at levels never really seen in other economies, even Japan or Korea, when they grew by 10% per year. The share of investment in GDP never reached a figure over 40%. In China, we are closer to 50%. In Europe, US, for instance, we are close to 20%. So this is clearly something which is not sustainable. So massive investments in real estate, railway construction, etc., or airports, ports, etc. And indeed, when we look, the Chinese authorities themselves are saying that they have to move from investment-led growth to a consumption-led growth. So to make sure that Chinese consumers will consume more and more every year, services, goods, etc. When you look at the figures of investment by sector in 2015, you can see that this is starting to happen. Investment in 2015 increased by 10%, but you can see on the chart that actually it was very contrasted by sector. Mining sector saw a decline of investment, not very surprising. Manufacturing was below, so manufacturing is really the bulk of investments, was below the average, so about 7-8%. But you can see that many sectors which are more like service-driven, like education, so it's hospitals, health, etc., saw an investment rate above 10%, sometimes 20%. So it's a first sign that the investment is going from sectors which are really capital intensive, like industry, mining, etc. Investment is going now to more services. So it's a sign that something is happening and it will change. It's the first step towards the consumption-led, let's say, growth for the future. The problem which was pointed out last year, the massive excess of real estate construction in 2014 continued to a lesser extent in 2015. Indeed, if you look at the left-hand side chart, you can see on the blue line that in 2014 and 2015, as I said, new construction declined. So there is a contraction of new projects. But at the same time, the total stock of construction under construction did not decline. So, and you can see the gap between the two. So there everybody knows it's difficult to estimate how much because many of these projects are still under construction. We don't know where they are. Maybe just the foundations. Maybe they have been more or less finished and the flats are vacant. Difficult to say. But it's clear that there is let's say, a massive quantity stock of buildings which have no use today, which are with the flats or offices which are vacant in China. So this is there is a need to reduce the activity of this sector. Another reason why one may say also that Chinese consumption has to decline is that we are not speaking about a country which, when compared with other countries, has still a potential to grow in consumption per capita, like India or many southeastern Asian countries. We are speaking about a country which already has a consumption per capita which is very high, 70% higher than in European Union. So the room to further increase is very limited. Let's have a look at the other regions. So China probably is going to further reduce its steel consumption. In the rest of the world, the outlook is much more contracted. If you compare apparent demand by region or by countries, 2015 compared with the pre-crisis level, so let's say 2007, you can see that Europe is still well below the level of 2007, with let's say minus 25% compared with 2007. The US has catch up, so consumption is roughly at the pre-crisis level. So probably in Europe, we believe that there is some room to improve demand. The construction has been clean in construction, for instance, in Spain and many other countries. The automotive sector also has suffered quite a lot. And we can see now that the outlook for the automotive sector in Europe is rather positive. So let's say we believe that it's one of the regions of the world, at least in the relatively developed countries, where we can be relatively optimistic. Of course, anything can happen if there is a Brexit or whatever. But the outlook, fundamentals for the steel demand in Europe, we think, are relatively good. Not brilliant, but not that bad. In other countries, because of the collapse in oil prices in particular, and more generally commodities, so countries like Russia, Brazil, Gulf countries, etc., the outlook is much weaker, because economists believe that in these regions, GDP growth will be maybe negative, or at least very, very sluggish. So decline of steel consumption probably in Brazil this year, in Russia, maybe in the Gulf. So outlook is in this category of countries is not excellent, very, very good. A region where probably we can expect relatively good momentum is Southeast Asia, with countries like Vietnam, Thailand, etc., where probably demand has room, and obviously as well India has room to increase in the next in 2016 and going forward. Starting from, as you can see on the right-hand side chart, very low levels compared with of consumption per capita compared with OECD countries. So this is my last slide. What about the profitability of the sector and of your companies and our business as well, as a bank financing the sector? We believe that the low utilization rate, which is, let's say, in many regions still below 75%, will be important hurdle to restore profitability in the future. As long as, for instance, in Europe, capacities have not been closed to a larger extent, it will be quite difficult to really restore very good margins in the sectors. The sector. Of course, the anti-dumping measures will help, and we have seen this already since, at least on the flat products in Europe, for cold products and now hot rolled coils. There is, and the US, it was even more obvious with the import duty of 500% against Chinese exports. This will, of course, restore some kind of probability of profitability of the sector. But as long as let's say, the domestic competition with overcapacity is there, we do not believe that the margins will be restored to levels which will allow to really invest and be confident about the future. So there's still effort to do in the industry to, let's say, to rationalize and to optimize the asset base. Another issue is that we think that, as we have said with the boron and chromium game, Chinese exporters will probably adapt to these new constraints and these new barriers which they face. I was at the CRU conference in Düsseldorf last month, and of course all the flats, essentially flat steel producers in Europe, were calling for more protection, etc. And there were a few remarks quite interesting by suppliers of equipment, which were saying, what you do not really realize is that Chinese, you think for the time being that Chinese exports to Europe, flat products, are relatively commodities and low quality. You do not realize that they are going to catch up, and that in 1 year, 2 years, they will start to target the automotive sector and with a very high quality, because the suppliers of equipments themselves are helping them to reach this level of quality of the European mills. So this is something which European and not only European steel producers will face, is the quality improvement of Chinese exports. This will definitely happen, and this may challenge some of the market shares in the segments which are the most profitable, like the automotive for the flat producers. The only thing, the other thing is that probably in 2015, imports in the US from Vietnam increased very substantially. And this is something that may seem a bit strange, and that we will probably see from other regions. We believe that the Chinese may directly or indirectly exports from other regions through, let's say, re-rolling, galvanizing, whatever operations. So it will not be classified as Chinese steel. The crude steel will come from China through semis or from HRC, go to other countries where there is also domestic consumption, and then could be redirected to other regions which have imposed anti-dumping measures against China. So in a way, it's a way that would be value added. It's not fake origin, that there will be some processing in these countries, but this will not be classified as Chinese exports. So what the steel producers have to do to further restore profitability? So as I said earlier, they have to consolidate the industry, and this is happening already. We can see that there will be some consolidation of the industry. They have to move up to higher value products, more services, etc. This is a must to fight against Chinese exports. By the way, Chinese are also investing in distribution in Europe, and so a way of better knowing the market and channeling their products. Mills obviously have to be efficient in terms of energy consumption, etc. And they have to be also flexible in this environment where you have large swings in prices. To be flexible, as I said, and it's not because there are a lot of Turkish companies in this room that I'm saying this, but every time I'm visiting steel clients in Turkey, I'm quite impressed by the way they have been able to manage the 2008 crisis through channeling rapidly products to other regions, or from switching from scrap to semis, or from flats to longs, etc. So flexibility in this kind of environment is really essential. So last word about what we are doing. So we are financing, we have a strong expertise based in Geneva. BNP Paribas is a French bank, but historically the sector has been financed, and the expertise is really based in Geneva, because from Geneva we were financing a lot Russian, Ukrainian producers when we could. Now we are targeting more other regions like Europe, Turkey, Gulf regions because of the sanctions, but this is really where the steel expertise is. We are very committed to the industry. Since the beginning of the year, we have closed 3 transactions, 1 in Turkey and 2 in the European Union. We also believe that bank financing for steel producers now is a good option compared with other sources of financing, because the equity markets have collapsed, at least for commodity producers like steel producers. Bond market is also not so open because many ratings have been downgraded. So the conditions on the bond market are not very good for steel producers. So bank products with a bank which is able to understand the needs of the clients in the long term, which is not reacting to the news in the press, but which has really an understanding of the fundamentals of the sector. This kind of relationship is essential for steel producers. And again, we are very committed to financing the industry, obviously on a selective basis, because now it's difficult to speak about the steel industry in general, because when you look at the EBITDA margin in Europe, let's say in Turkey, it goes from minus something to 20 plus. So obviously we prefer the players with 20 plus than the players with minus something. But again, our strength is that we can really analyze the fundamentals of the clients and to understand more or less, hopefully, where they are going. Thank you very much. We have questions now or after? If you want to ask some questions, we'd be delighted to try to answer. Yeah, sure. Uh-huh. Well, in Europe, it's happening with the ArcelorMittal closing mills in Spain, for instance. There is the status of Tata. I don't want to comment too much on this. Tata UK, Tata Europe Steel. We can see that things are changing now. The industry is. There's on the flat product, there's a ILVA issue in Italy, but things are moving, I think. Yes, essentially for the time being in Europe, yes. But Turkey, I know that consolidation is a very probably sensitive issue. It's not going to happen for many reasons, but.
Hello, this is Mustafa from Istanbul Demir Metal. Thank you very much. It is very explanatory information with numbers, supported with the numbers. But the question here how could industry cope with this price difference, cost difference between iron ore-based mills and arc furnace-based mills? As you said, beginning of your speech, when there is a sale of $50, $55, the cost of iron ore supplier is hardly around $25. And there is excess capacity of iron ore supply. When this is the case, iron ore suppliers cannot improve the price. So blast furnace mills getting cheaper iron ore and with less cost. How long this price cost difference stay in the market? That means the Chinese producers and integrated mills is making $110, $120, whereas arc furnace mills making maybe hardly $10, $20. How could this situation continue? Do you have idea on that? How we can observe the signs that this may stop? I mean, my idea is probably when we see a little bit of softening local Chinese prices, then there is a danger of price decrease, and we will witness maybe sharp decrease at that time. Hope it doesn't happen, but this is the risk, and this question stays there. I wish there could be some iron ore suppliers here to contribute their ideas to discussion, but none of the players here are market makers. So we are just observing the market, and I think we have to observe the market in China domestic prices. When there is a sign of softening, and it's a danger for the current situation would start. So what is your observation on this? What is your ideas on this? I'd like to hear. Thank you.
Yes, I think that there is a very serious threat, obviously, especially if there is a further contraction of construction in China with a lower utilization rate of the long rebars, etc., and the low iron ore and coking coal prices, there is a threat for scrap-based producers, which is still there. And again, we may question whether we are really for good out of hell, or whether there are still risks that we may get there again. But in the more medium long term, if we try to think of something positive also, which may happen to the industry, it seems that scrap generation in China itself is increasing a lot, because and actually I don't remember exactly the figure, but last year for the first time, imports of scrap to China were, I think, quite limited compared to the past. So, and some people even think that maybe in the future China could export scrap. I'm not sure, because what the Chinese will do in the first place is to build, as they know how to do this, and very cheap and relatively cheap, build electric arc furnaces to process this scrap. But this means that maybe as China will start to generate more scrap from because the time also between consumption and scrap generation in China is probably shorter than the rest of the world, there will be much more scrap coming out from China, and this could a bit release the pressure on the scrap producers globally.
Can you tell us what indicators we should check in Chinese local market? Because when we see China's steel price already the local market softening, it is becoming too late, and then the collapse starts. But before coming to that, maybe there could be other indicator. As a banker, you can tell us, we have to check this, we have to check this indicator or so on, so that before it is reflected to Chinese local price, we can, at least, I don't know, a few weeks ago or a month ago, we can see there is risk coming. There isn't such a thing currently, as I understand. Also, this scrap issue, I don't think is in a short or medium term will affect anything in the industry. But do you suggest for us to follow some indicators other than prices there? Like, I don't know, some construction index or something that when there is a decrease or softening, this can reflect lower steel prices domestically. Can you say something about this? Thank you.
Well, it's not easy to answer, but I think that yes, there are one of the main indicators that, especially for long products, is construction in China, and clearly it's not very positive. I think. I'm sorry, I cannot really give you more hints about.
That would be probably $1 million question. Thank you. Any other questions for Eric from the floor? I guess
but don't hesitate during the breaks to discuss. We'll be more than happy with my colleague as well, Alexander.
So thank you very much.
Thank you.